A while back, I had a very memorable time talking to Anders Lindell, discussing many fascinating aspects of global macro trading. There was one part in particular that I wanted to share where Anders talks about and discusses his understanding on US institutions and how they deal with their asset allocation, and in particular the sizing of their alternative investments. So get ready to listen to some truly great insights from Anders Lindell, and if you would like to listen to the full conversation, just go to toptradersunplugged.com/23 and also /24. Before we jump into the first sort of topic, more specifically to IPM, I want to ask you, you mentioned the traditional 60-40 bond stock or stock bond, depending on whether you were European or US institution. They seem to have a little bit of a different asset allocation as far as I remember. Mm-hmm. But the world has changed in the last 10, 20, 30 years, of course. And I just wonder, from a really big picture point of view, how do you see them dealing with this asset allocation, not from what you do, but from what they do and how they may interact with firms like you? I mean, are they becoming more open? So it's not just 48, 52 that they change to, or whatever it might be. I mean, are they starting to take bolder decisions in their own asset allocation?
There's a whole range of answers to that. I think generally the answer would be yes, on sort of a global basis. Mm-hmm. I think if you look at US institutional investors, they probably come further than their European counterparts in allocating very significant parts of the risk budget to, folks like ourselves and generally hedge funds. Whereas, in Europe, finding a long-term institution having a hedge fund allocation exceeding 3, 4, 5% would be unusual. Finding the same in the US would be the norm, being north of that, even up to 10, 15%. Okay. That would be the norm. But then, you have obviously various examples. I mean, if you look at your own native country and the big pension fund there, ATP, they instituted, I believe, about 10 years ago, a radically different asset allocation structure from the traditional, where they basically, and you can correct me if I'm wrong here, but basically what they do is they sort of equal weight their risk budget across, 10, 15 different asset classes, ranging from infrastructure to, traditional markets.
Sure.
So people are doing a large number of different things. But I think the general observation holds true that North Americans, generally speaking, are much more into seeking alternative sources and allocating significant parts of the risk budget to those alternative sources of returns than Europeans are.
Sure.
Obviously, this also has something to do with, the state generally of the pension systems. If you look at U.S. pensions, corporate and state, they are generally underfunded to a very large degree, 60-70% funding ratio, whereas most European countries that has funded pension systems would have significantly higher funding ratios. Many of them actually 100% or better.
Okay.
So this obviously changes your long-term strategic allocation. Yes, you got to match liabilities, but if you're underfunded, and if you're running something at 70% funding ratio, then you better seek methods to make up for the shortfall pretty quickly. Another major point that I want to mention is actually time horizon or investment horizon.
Okay.
People may trade in or out or create trends and prices may deviate. It's just noise. Mm-hmm. Over shorter time spans. And we're trying to step back and avoid that by explicitly trading and holding positions a longer period of time.
A couple of things comes to mind when you say that. I mean, in one sense, it actually is a great injustice, not just to your strategy, but to many strategies, you could say, is for investors to look at these things on a monthly basis and kind of judge you on based what did you do last month, because what you're really saying is that part of the success is having the ability to take a much longer view and not be concerned about, an adverse move over the next few weeks, because it's going to work out maybe over the next few months. But I also wanted to ask you a little bit, just position sizing. Is that the secret sauce, do you think? Meaning that a lot of the themes that you end up in, and I imagine a lot of the strategies and positions you end up in would be somewhat similar to other global macro managers. But I do note that you've done quite well compared to your peers. And do you think position sizing is part of the success, that you simply manage the risk differently, maybe?
Yeah, I think there are several parts to it and several moving parts here. What I tend to say to clients that want to evaluate what it is we're doing is that 9 out of 10 clients, for good measure, I'll throw in the consulting community here too. Right. They are spending way too much time focusing on what we refer to as those risk factors. Right. They want to know them all, and they're looking at purchasing power parity, and they want to understand exactly how we build that particular factor, while noting that academically speaking, PPP has a mean reversion time of 50 years, clearly not investable. Sure. And they're spending all of their time trying to understand, do you have the right alpha sources? Are they advanced enough? Are they sophisticated? Do they differ from your competition? And, that guy over there, they also have PPP factors. Well, those alpha sources, risk factors, yes, they're important, obviously. They're very important. But risk and portfolio construction, respectively, contribute, to the same degree to the final result. So I would say, spend 1/3 of your time trying to understand what we do on the alpha side. The other third you should spend on risk management, and the third you should spend on understanding our portfolio construction.
It's very interesting because it seems to me that maybe unlike a lot of people doing relative value, where I think to some degree they're trying to take out the volatility of their returns by doing relative value. What you're doing is saying we're doing relative value, but we're actually okay with having volatility in our returns, because we can't remove volatility from inherently underlying assets that are volatile.
Mm-hmm. Yeah, that's an interesting observation. I think another way of looking at it is to say that the volatility that we get, and certainly some of the drawdowns that we, as everyone else gets, they are the price you have to pay because you don't have obviously perfect insight. In our specific case, we believe we have the right positions, but the timing, we don't really know when markets are going to start moving back to that sort of longer term equilibrium. So we have a problem with timing. That's why we simply say we start building positions. We increase positions as the opportunity increases, to a good degree. Yeah. And meanwhile, we're not happy, but we're prepared to take the losses to build that position. And we are happy to take we have to accept the associated volatility, because again, we don't know when the market is going to turn.
What keeps you awake at night? Meaning, what is the risk that you fear the most? Because at some point, there is obviously something that, you can't guard against, even with the most elaborate strategy and risk management. What would that be?
Generally speaking, I sleep very well. My wife would be the first to testify to that. Sure. But what, if anything, would keep me awake at night? Situations when markets quite apparently behave irrationally. Right. And certainly when they continue behaving, and pretty much everyone would agree, they continue behaving irrationally for some time. Because then we find ourselves in a situation where we cannot expect the model to act in a predictable fashion. Whether we make money or not, or lose money or not, is entirely random, such a scenario. And we're not in the game of sort of taking big positions in, and we do take pretty significant positions in this program. It is not really built to collect on random behavior. And these scenarios, they do occur from time to time, when we'll focus on something completely different.
Sure. Do you think the risk of markets behaving completely irrational, has that increased in the last few years with so much involvement from politicians and central banks? Or is this just part of
I think most people looking at their lives trading experience, my age, we've been talking about 20, 25 years, they would probably say that's true. On the other hand, if you read whatever book on the topic, and you go back to the Dutch tulip mania, or market crashes in the late 1800s, etc., I'm not so sure that market and investor irrationality has increased over time. I think we feel that at the current time, probably, but that's only because our time window is too short.
I want to jump to the next topic, just again, very briefly. It's just a little bit about drawdowns. I want to ask you a little bit about what one should expect in terms of drawdown from a strategy like yours, but also want to ask you how you cope with being in a drawdown. I noticed that obviously your drawdowns are not that large, if I can put it like that. But the emotional roller coaster that we tend to go in if we are in a drawdown, especially if it's a deep one, but also if it's a long one, can be, that's part of what's being hard, I think, about being in this business. So I just want to sort of maybe ask you a little bit about how you cope with these things emotionally. And maybe that's not from a recent example, but maybe sort of over your career.
I think a main source of strength in this type scenario is that we are systematic.
Right.
Had we been discretionary traders, and you would face some of the drawdowns that we've had, and probably our largest drawdown would have qualified for us losing the money if we've been on a prop desk almost immediately, or at least seeing it halved or whatever taken away. But as we are systematic, we have to seek comfort in the fact that we believe the model is right over time. We believe this is temporary, and eventually it will come back. If we start tampering with the model, or we start sort of adding to delivering by discretionary measure or such things, then in all likelihood we're only going to make the situation worse. So this is a program that we traded for a very long time. We put enormous amount of manpower and brain power into the development of it. We believe it has proven itself. So, the main thing here is really to seek comfort in the fact that we're systematic, and then this really comes down to one of the reasons for being systematic in the first place, right, is to avoid exactly this emotional behavior. You would be most inclined to kill your positions just when it feels the most uncomfortable.
That's it for today. Remember that if you want to continue listening to the full episodes, please go to toptradersunplugged.com/23 and /24. If you enjoyed this short, insightful clip from a past episode of the show, then you will love the free book I'm giving away right now. It's called The Many Flavors of Trend Following and includes some of my best insights on this perhaps the most dependable and consistent yet often overlooked investment strategy. You can get your free copy at toptradersunplugged.com/book right now, and you can start your own journey today. Just head over to toptradersunplugged.com/book and make sure to tune back into the podcast or YouTube channel next week for more exciting and engaging conversations.